Preparing for an investment banking at Bank of America interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your resume and explain why Bank of America Investment Banking. I would keep this chronological and selective. I studied finance because I liked connecting numbers to business decisions, then built technical skills through valuation coursework and internship experience. In each role, I tried to own details, communicate clearly, and work under tight deadlines. Bank of America appeals to me because it combines a top global advisory and capital markets platform with a collaborative culture, which is the environment where I think I can develop fastest. While answering, connect your experiences to transaction execution, analytical rigor, teamwork, and client service. Show a clear reason for Bank of America, referencing platform strength, product breadth, culture, and long-term career fit. Question 2. How do the three financial statements link together? The income statement starts with revenue and expenses to arrive at net income. Net income flows into shareholders' equity through retained earnings and also begins the cash flow statement. On the cash flow statement, I add back non-cash charges like depreciation, adjust for working capital, subtract CapEx, and reflect financing activity. Ending cash then flows to the balance sheet. If the model is built correctly, assets equal liabilities plus equity, with cash as the plug. Make sure to cover net income flowing into retained earnings, depreciation and working capital affecting cash flow, CapEx and debt changes on the balance sheet, and cash as the final balancing item. Question 3. Walk me through a DCF. A DCF values a company based on the cash it can generate, not just market multiples. I project unlevered free cash flow for 5 to 10 years, usually starting with EBIT, taxing it, adding back D&A, subtracting CapEx, and adjusting working capital. Then I discount those cash flows at WACC and add a discounted terminal value. That gives enterprise value. After subtracting net debt and other claims, I reach equity value and an implied share price. While answering, focus on projecting unlevered free cash flow, discounting it at WACC, calculating terminal value, deriving enterprise value, then moving from enterprise value to equity value and implied share price. Question 4. Which valuation method usually gives the highest value? Precedent transactions often produce the highest value because buyers pay a control premium and may underwrite synergies. A DCF can also be high if the projections are aggressive or the terminal value assumptions are generous. Trading comps usually reflect minority public market value, so they are often lower. LBO analysis tends to be the floor because a sponsor needs to hit a target IRR. The honest answer is that the ranking depends on assumptions and market context. In your answer, compare DCF, precedent transactions, comparable companies, and LBO analysis. Explain why control premiums, synergies, market conditions, assumptions, and required sponsor returns can shift the valuation range. Question 5. What is WACC and why do we use it in a DCF? WACC is the blended required return for all providers of capital, equity holders and debt holders. In a DCF, I use it to discount unlevered free cash flow because that cash flow is available to both groups before financing costs. The cost of debt is tax affected because interest is deductible. The cost of equity is usually estimated with CAPM. Using market value capital structure weights, WACC converts future operating cash flows into enterprise value today. Be sure to mention cost of equity, after-tax cost of debt, capital structure weights, tax shield, and why WACC matches unlevered free cash flow discounted to enterprise value. Question 6. If depreciation increases by $10, how does it affect the financial statements? Assume a 40% tax rate. A $10 increase in depreciation reduces pre-tax income by $10, so taxes fall by $4 and net income falls by $6. On the cash flow statement, net income is down $6, but depreciation is added back by $10, so cash flow increases by $4. On the balance sheet, PP&E is down $10, cash is up $4, and retained earnings are down $6. While answering, use a tax rate assumption, walk through income statement, cash flow statement, and balance sheet, and show that cash rises by the depreciation amount multiplied by 1 minus tax rate. Question 7. How do you calculate enterprise value from equity value? To move from equity value to enterprise value, I add debt, preferred stock, and non-controlling interests, then subtract cash and cash equivalents. The intuition is simple. An acquirer would have to assume or repay debt-like claims, but would receive the target's cash. Enterprise value measures the value of the operating business available to all capital providers. That is why multiples like EV/EBITDA compare operating value to operating earnings before financing choices. Make sure to cover equity value, debt, preferred stock, non-controlling interests, cash, and the intuition that enterprise value represents the value of core operations independent of capital structure. Question 8. Why might two companies with the same EBITDA trade at different multiples? A multiple is really shorthand for expectations. Two companies can have the same EBITDA today, but the higher growth company with stronger margins, recurring revenue, lower capex needs, and less cyclicality will usually deserve the higher multiple. Investors are paying for the durability and growth of future cash flows, not just this year's earnings. Leverage, management quality, competitive position, and sector sentiment also matter. So equal EBITDA does not mean equal value. In your answer, talk about growth, margins, revenue quality, cyclicality, capital intensity, leverage, management, market position, and risk. Connect the multiple to expected future cash flow and return profile. Question 9. What makes a merger accretive or dilutive? A deal is accretive if the buyer's pro forma EPS is higher after the acquisition and dilutive if it is lower. The main drivers are the purchase multiple, financing mix, cost of debt, lost interest on cash, new shares issued, synergies, and transaction adjustments. As a shortcut, if a high PE buyer uses stock to acquire a lower PE target, the deal is more likely accretive. But you still need the full model. Be sure to mention buyer PE versus target PE, purchase price, financing mix, interest expense, foregone interest, synergies, amortization, tax effects, and the impact on pro forma EPS. Question 10. Walk me through a simple LBO model. In an LBO, a sponsor buys a company using a mix of debt and equity, then exits later at a higher equity value. I start with purchase price and transaction fees in uses, then debt and sponsor equity in sources. I project EBITDA, capex, working capital, and free cash flow to see how much debt can be repaid. At exit, I apply an exit multiple, subtract remaining debt, and calculate the sponsor's MOIC and IRR. While answering, cover purchase price, sources and uses, debt schedule, operating projections, exit multiple, debt paydown, sponsor equity proceeds, MOIC, and IRR. Keep the explanation execution-oriented. Question 11. How would rising interest rates affect Bank of America's investment banking clients? Higher rates usually raise the cost of debt, reduce financing capacity, and pressure valuation multiples because discount rates increase. For clients, that can make leveraged acquisitions harder, delay IPOs, and create refinancing concerns for companies with near-term maturities. At the same time, volatility can create strategic opportunities for well-capitalized buyers. As a Bank of America banker, I would help clients evaluate timing, financing alternatives, hedging, liability management, and whether a transaction still creates value under downside cases. In your answer, connect macro conditions to debt financing costs, valuation multiples, M&A appetite, refinancing risk, equity issuance windows, sector winners and losers, and the banker's role advising clients. Question 12. Pitch me a stock or company you would discuss with an investment banking client. I would pitch Adobe as a high-quality software company facing a strategic AI narrative shift. The core business has recurring revenue, strong margins, and significant cash generation. But investors are focused on whether generative AI expands the market or compresses pricing. For an investment banking discussion, I would frame potential acquisitions, capital return, and investor communication. I would also compare valuation to software peers and highlight risks around competition, regulation, and execution. Make sure to cover business model, industry backdrop, financial performance, valuation, strategic alternatives, risks, and why the idea matters for an advisory or capital markets conversation at Bank of America. Question 13. Tell me about a recent M&A transaction and whether you think it made sense. One deal I followed was ExxonMobil's acquisition of Pioneer Natural Resources. Strategically, it made sense because it expanded Exxon's Permian Basin position, added long-duration inventory, and created scale efficiencies. The all-stock structure preserved cash and let Pioneer shareholders participate in the combined upside. The key questions were commodity price exposure, integration, and regulatory review. I would judge success by realized synergies, production efficiency, capital discipline, and whether returns exceed Exxon's cost of capital through the cycle. Be sure to mention transaction rationale, valuation, consideration mix, synergies, strategic fit, regulatory risk, shareholder reaction, and how you would assess success after closing. Use a real deal, not vague headlines. Question 14. Describe a time you worked on a team under pressure. During a student investment fund pitch, our team had 2 days to rebuild the model after new guidance changed our thesis. I took ownership of the valuation, divided research tasks across the group, and scheduled quick check-ins instead of long meetings. We caught an error in the working capital assumptions and revised the recommendation. The pitch went well because we stayed organized under pressure. That experience matches banking. Deadlines are tight, but accuracy and teamwork cannot slip. While answering, use a concise STAR structure. Show ownership, communication, prioritization, attention to detail, and resilience. Tie the example back to investment banking's deadline-driven, team-based environment. Question 15. Why should we hire you for Bank of America's Investment Banking Analyst program? You should hire me because I have prepared for the technical work, I understand the intensity of the role, and I have evidence that I can perform in team settings. I enjoy valuation, accounting, and strategic problem solving, but I also like the client service side of banking. Bank of America's global platform is especially attractive because analysts see both advisory and financing perspectives. I would bring strong attention to detail, low ego, and a willingness to learn quickly. In your answer, combine motivation with evidence, technical preparation, stamina, coachability, client mindset, teamwork, and genuine interest in Bank of America's platform. Avoid generic claims without examples. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.